Did you know that there was a global economic meltdown that is taking place? This is no scare tactic, believe me. We all know that COVID-19 pandemic has dented the world economic growth, affecting businesses and people's livelihoods. Hi, I'm Kavit Halfway. In this edition of Economic Divide, we'll tell you how the entire world has been propped up by central banks around the world, accumulating massive deficits in the process. Now, coming up in today's program, the COVID-19 pandemic has affected the world economy. But did you know by how much and how badly? How does $834 million an hour sound? And that is to keep the economy alive. Then, a key question needs to be asked. Why did central banks have to do that? Why did they have to print money? To help companies stay afloat during lockdowns, which led to the biggest stock market rally of a generation. And finally, we're going to take a look at the central bank's function, how they absorbed so much of the bond market, more than $16 trillion in debt with a negative yield to have been accumulated. Is this a debt time bomb that's overdue waiting to happen? Borrowing and debt, they go hand in hand, and there was plenty of that going on around the world last year. Governments, households, and companies raised $24 trillion last year to offset the pandemic's economic toll. By doing that, the global debt was pushed to an all-time high of almost $300 trillion. That is more than the 355% of global GDP, according to the Institute of International Finance. And there's even more borrowing ahead. The COVID pandemic has added $24 trillion to the global debt mountain over last year. That means that the debt as a ratio of world economic output, known as gross domestic product, has surged by 35 percentage points to over 355% of world GDP. This is well beyond the rise seen during the global financial crisis. And there's also little sign of a near-term stabilization. Borrowing levels are expected to run well above pre-COVID levels in many countries and sectors again this year, supported by still low interest rates, although the reopening of economies should help on the GDP side of the equation. The IIF has said we expect global government's debt to increase by another $10 trillion this year and to surpass $92 trillion. Adding that winding down support could also prove even more challenging than it was after the financial crisis. The problem with debt and money printing is that they are short-term solutions with long-term problems, which puts the future generations at risk. Let's not forget that the 2008 financial crisis, which started in the U.S. and spread across the world, had large stimulus spending. If you recall, they were called bailouts. The U.S. government spent around $700 billion, called the Emergency Economic Stabilization Act of 2008. The EU amount, though, came in at a much higher cost. How could anyone forget the then ECB central bank chief, Mario Draghi, who said the ECB will do whatever it takes to save the euro. That whatever it takes amount 2 trillion euros. Well, joining us for a cost breakdown, literally, is Jack Rasmus. He's a professor of economics at St. Mary's College and Santa Clara University. He also holds a PhD in political economy and is the author of The Scourge of Neoliberalism, U.S. Economic Policy from Reagan to Trump. Well, Jack, welcome. Global central banks led by the U.S. Federal Reserve, the European Central Bank, and also the Bank of Japan, unbelievably have collectively spent $834 million an hour. That's $13.9 million per minute for the past 18 months to keep businesses rolling. I mean, it's hard to even wrap our mind around that figure. What does that mean? I mean, does it mean if it didn't do that, the world economy would fall apart?
Well, you got to distinguish between central bank balance sheet debt, which you started talking about, and what the sovereign governments undertake in terms of debt on their spending programs and tax programs. And then you probably should talk about local government, provinces, states, and so forth, which aren't even in that data. And then there's household debt and there's corporate business debt.
All right, but that doesn't answer the question as to why there are reports that so much money has actually been spent by these central banks. I mean, on what sector is this money being spent on?
The level of debt by itself is not the whole problem. You can have an increasing level of debt as long as the economy, the real economy, is growing. GDP is growing. Of course, it hasn't been. What's important is the ability to service that excess debt. Service meaning pay the principal and interest down the road. When you can't pay the principal and interest, that's when you have defaults. Now, sovereign debt, you're not going to default. Certainly not in the United States. The U.S. can monetize that debt, print money, whatever, right? But corporate debt is another question. And household debt is another question. And even state and local government debt is another question. We shall see whether the consequence of this COVID-exacerbated global recession, which is still with us, not just COVID still with us, but the recession's still with us. What you got is a rebound of the economy in the U.S. You don't have a sustained recovery yet. We shall see whether the real economy is going to generate enough income to service that massive debt addition that's occurred here. Just to take the Federal Reserve.
It's time now for our Info News section. As you're well aware by now, here's where we pick up stories that best reflect the theme of our program: social inequality, poverty, and injustice. Now, first up, an event that would have taken place by the time you're watching this program, and that is the UN Food Summit. Now, the summit said that it's not going to achieve anything meaningful because of corporations, and this is pretty important. And the reason why it said that is because it says that corporations have engineered our current broken food systems. So that is what needs to be addressed by the summit, if that is something that will actually get done. That is the key question. On to Europe and gas prices there. You're well aware by now, gas prices there are skyrocketing. Obviously, that's going to pose a big worry for the EU economy as a whole. European gas prices to have been hitting record highs. What is the reason behind that? Well, some say it's due to low storage volumes and the fast approaching winter. But low supplies from Russia and uncertainty about the Nord Stream 2 gas pipeline are other reasons. And also the lack of drivers. It is said that they need 90,000 drivers to actually deliver the fuel. So that's another reason for this. And talk about oil. China's oil imports is our next topic. China has cut its oil imports and has ramped up purchases of natural gas, and it has reduced its crude imports by 5.7% since the start of 2021. At the same time, it has boosted natural gas purchases by over 20%. It seems that independent refineries slowed their restocking due to official probes into trading and taxes. Then moving on here to AI technology. Big concern, the UN Human Rights Chief coming out calling for a global halt to sales of dangerous AI technologies. Why is she calling AI technologies dangerous? Well, yes, AI has to serve people. That's undeniable. But AI's ability to feed human rights violations or to commit human rights violations, to be part of that at an enormous scale with virtually no visibility, that is a problem. And her remarks came at the hearing of the Pegasus scandal, the Israeli spyware firm which was used to target civilians. It's time now for our in-depth section of the program. For this topic, we're going to take a look at what's called QE and what it means and how it functions in order to get a better idea of why this program has been popular. Now, quantitative easing, or QE as it is called, is referred to the introduction of new money into the money supply by a central bank. Now, this process, quantitative easing, helps the economy. How does it do that? It reduces long-term interest rates, making businesses and mortgage borrowing cheaper, and by signaling the Fed's intention to keep using monetary policy to support the economy. Now, the Fed turns to this process, QE, when short-term interest rates actually fall nearly to zero and the economy still needs help. In response to the economic impact of the COVID-19 pandemic, the Federal Reserve has actually done some things regarding the QE. It has cut the short-term interest rate down to zero. That happened on March 15, 2020, and restarted its large-scale asset purchases, more commonly known as quantitative easing, or QE. And since July of 2020, the Fed has been buying $80 billion of Treasury securities and $40 billion of agency mortgage-backed securities each month. Now, the potentially imminent decision by the Fed to begin reducing this $120 billion in monthly asset purchases, the Fed Chair Powell said that the weeks since the Fed's policy meeting in July brought more progress towards repairing the jobs market, with nearly 1 million positions added, and that progress should continue.
Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete.
Obviously, the key there, until the recovery is complete. However, this also coincided with the further spread, unfortunate for the U.S. and the world, of the Delta variant.
What happened was Delta happened, and you have this very sharp spike in Delta cases, and I think so that affects, for example, when schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant. You might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that.
Yeah, obviously there the Fed is explaining the QE program, why it needs to continue, because he says one reason is that people are going to go out there and get a job, but yet if they're going to have to quit because of COVID, they're not going to do that. Well, the further spread of the Delta variant did obviously affect the Fed's plan to reduce this QE. Nevertheless, the Federal Reserve on September 22nd cleared the way to reduce its monthly bond purchases soon, as it said, and then signaled interest rate increases may follow more quickly than expected. This would involve 9 of 18 U.S. central bank policymakers who have projected borrowing costs will need to rise in 2022.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete.
Let's try to get an idea about this QE. We have Justin Urquhart-Stewart joining us. He's director of the 7 Investment Management and founder and head corporate developments at the investment fund 7IM. Justin, welcome. How does the QE work? We know that it involves the printing of money. We also know that the New York Fed and the ECB have printed lots of money. Even the ECB said to have negative interest rates. Tell us how this whole process gets executed.
It's fascinating when you look at quantitative easing, because you find any economics book of, say, 30 years ago, and there will be no mention of it at all. So this is a relatively new phenomena in terms of its description and its application by central banks. All it is, in fact, is you're getting the government to be issuing debt, and then its central bank is then buying its debt. And therefore, what you're doing is creating that value, which you could then call printing money. But effectively, what they're doing is putting more money into the system. Now, that can work quite well. And of course, the clever thing is, if you think that the bank, central bank and the state are one and the same, then they've got the items on both sides of the balance sheet. You have the assets and the debt. So in theory, because they're one and the same, in due course, they can match them off and wipe them out. But they can't do that yet, because it would lose that vital word that runs any economy, which is confidence. And they have to have confidence in those central banks, so they know what they're doing. And I have to say, at the moment, there's a real concern when you look at the central banks, because they're now trying to ease the market forward to say to them, interest rates are going to go up, but they are not going to go up now, so there's no need to panic. And this is what we had a few years back when you had something known as the taper tantrum. They were going to taper down the level of quantitative easing, the levels of borrowing, and be able to try and make sure there is still support in the economy, and therefore interest rates will start going up from where they are at the moment, as you correctly said, when they were negative. So the market's going to watch this very carefully indeed. It's going to be an incredibly sensitive issue. Now, overlay on that the aftershocks of COVID, and we haven't resolved all of that issue. Overlay on that the geopolitical issues, particularly between America and China, and we have some very big risks to manage during this. So it's going to be a sensitive time with a very, very sensitive financial subject.
The money that the world is awash in is truly worrying. One thing not even covered in this program is the world of dark money. Anyways, all in all, the world is drowning in cash and in turn debt. The question that then arises is, how can this amount of debt ever be repaid? Well, of course it can't. The World Economic Forum blatantly admitted so. It said that at the end of 2015, Greece's public debt was 176% of its GDP, while Japan's debt ratio was 248%. The U.S. stands at 125%. None of these governments will ever repay all that they owe. Write-offs and monetization are inevitable. Total world public debt, 215% and rising. And that was back in the year 2016. Rejoining us for this final Q&A of the program is Jack Rasmus, Professor of Economics, and also we have Justin Urquhart, Stewart, Director of the Seven Investment Management. Jack, my final question to you. According to strategists at Bank of America, trillions of dollars, euros and yen have been created to shore up global financial systems, provide them much needed liquidity. But given QE and stimulus back from the 2008 financial crisis, isn't the world awash with so much debt that it's nearly impossible for it to repay back?
Well, it's not only awash with debt, but it's awash with an incredible amount of liquidity, money, capital all over the place. That's why these stock markets are not really correcting. There's so much trillions of dollars sitting on the sidelines in investors' hands that whenever the market starts going down a little, they commit more of this liquidity money. They pump it back up. They just keep buying the dips, and there's no corrections going on anymore because there's so much money that the Feds and central banks have thrown into the global economy. How long can this go? Well, the whole question is how long will the central banks keep throwing this money, especially Western central banks, into their economies and creating these financial asset bubbles?
Well, Justin, that sounds like a good question that I could throw at you. For how long can this then go on? Which, as our guest Jack Rasmus indicated, has created this financial bubbles with all this money being pumped into the system, giving QE and stimulus from the 2008 financial crisis. Isn't the world now awash with so much debt? Again, my question that there's no way that it can possibly repay it back?
The answer to the question is actually in the question itself. The world is awash with all this debt. And the question is, therefore, can it be sustained? Well, it can be sustained as long as you have that vital word of confidence again, or you'll have that other phrase, which is the emperor's new clothes. That's to say, does everyone stop losing confidence in actually what's happening? And then they start selling, and that's when you'll see a real danger to the global economy. So the central bankers have to manage this very carefully indeed. We have eye-watering amounts of debt, which, after all, neither you nor I can actually get enough numbers, enough noughts on our calculators to actually see it. So what they need to do is manage it over the longer term. They've got inflation beginning to rise, which is quite helpful because it starts to erode the value of the debt. But inflation has a nasty habit of getting out of hand, so they've got to be careful. If they raise interest rates too quickly, they'll frighten the market. And if you raise interest rates at all, the cost of that debt does go up. And that's going to be a large cost, which, frankly, none of these nations are really prepared to be able to manage effectively.
Global debt is spiraling out of control and is fast approaching record $300 trillion. It seems like many countries are after debt restructuring for taking on too much debt, especially after the economic fallout due to the COVID-19 pandemic.
Hoy tenemos es que el 99% de la deuda pública en moneda extranjera, bajo ley extranjera, ya ha quedado reestructurada.
Las deudas hoy nos permite lograr que en los próximos 10 años el país libere más de 16.000 millones de dólares del pago de deuda.
Even Europe's economic powerhouse, Germany, is plagued with debt, so much so that it had to come out and defend its borrowing.
Wenn Sie sich das im Vergleich mit anderen Ländern anschauen, dann werden Sie sehen, dass wir natürlich dadurch die Schuldenquote steigern werden auf 77% nach den Berechnungen.
Some lucky countries, like Mexico, did not need to accumulate debt coming out of an economic crisis.
Y vamos a salir de la crisis económica sin contratar deuda adicional y sin destinar dinero público a rescates, entre comillas, inmorales.
That, of course, is a rare thing, like for one of the biggest holders of debt, namely the US. It holds so much debt that it can default on its national debt by not raising its ceiling.
It is imperative that Congress address the debt limit. If not, our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th.
Total debt levels are measured by levels accrued in government, household, corporate, and bank debt. Here is an outline of the $300 trillion. Starting from the year 2014, the figure stood at around $210 trillion, and slowly it increased until the spike happened in 2020 when the COVID-19 pandemic hit, bringing the total global debt to around $300 trillion. The countries with the most external debt are listed here based on their ranking. The US at number 1, followed by the United Kingdom, France, Germany, then Japan. And based on this borrowing trend, the IIF, the Institute of International Finance, has said that if the borrowing continues at this pace, we expect global debt to exceed $300 trillion. But even before the pandemic, debt levels were not sustainable, especially for developing countries and the world's poorest nations. COVID-19 has increased the challenge exponentially. The rise in developing countries' total debt is at its highest level on record. It is at 193% of the GDP in 2018. This is while the global debt is 260% of GDP by end of 2021. But the borrowing started way before the pandemic, so it's not just about COVID-19. At the start of the decade, the ratio was close to 300%, and in 2008, it was 280%. The first UN Ministerial Roundtable, called the UNCTAD, dealt with the COVID-19 emergency, and debt accumulation was one of the topics.
Our planet faces an unprecedented health, social, and economic crisis, one that puts every nation on Earth in danger.
The Prime Minister of Barbados issued a stern warning.
We are either going to find ourselves servicing debt or servicing people.
Let's take a look at what she has actually said. Let it sink in. We are either going to find ourselves serving debt or servicing people. We have to make the choice. Tough words, but the truth. High borrowing levels will have profound consequences for the global economy. But the biggest question of all is, will this debt ever get repaid? Please write to us. The following are our links and addresses. See you next week.
The global economy has taken a severe hit from the COVID-19 pandemic. No questions about that. On top of that, as a consequence, supply chains and links have been broken, which means that many third world countries that are part of that, for example, have gone out of business. That gives further strain on production or overall providing goods and services. Now, this means that there really was no option for this stimulus. But the repayment of this debt, that's the key question. With so much money pumped into the system, well, inflation is sure to follow, as it has, like in food prices and other